Good afternoon, good afternoon, everybody. Welcome to today's webinar on cash flow management for small businesses. This program is being presented on behalf of all of the chapters in the Massachusetts, Rhode Island district of SCORE. I'm Jim Danhauser. I'm a volunteer mentor with the Cape Cod and Islands chapter of SCORE. And leading today's discussion, along with my colleague from Boston, Gloria Spence. Before beginning the discussion, there's just a couple of items that I wanted to cover as an introductory matter. For those who are not familiar with SCORE, we're a fully volunteer nonprofit organization and a resource partner of the U.S. Small Business Administration. SCORE's mission is to foster vibrant small business communities through mentoring and education. We've been doing this work since our founding in 1964 by presenting educational opportunities like this webinar and by providing mentoring assistance to people who are in business or who are thinking about starting a business. Each of the 7 chapters in our Massachusetts, Rhode Island district has a significant number of volunteer mentors with a broad array of business experience and expertise, all of whom stand ready to provide mentoring assistance to you. And we can connect you with volunteers throughout the country, so we should be able to satisfy the needs of virtually every client. Importantly, all of the mentoring that SCORE does is absolutely free and completely confidential. Very easy to sign up for a SCORE mentor if you'd like to do that. You see at the top a screen grab from the national website. So you could go to www.score.org, go to the Find a Mentor tab, and click on Request a SCORE Mentor in the drop-down menu. Just enter your zip code and you get going. You could also go to the website of the SCORE chapter that covers your geographic area, and you see those websites listed there. Again, you would click then on the Find a Mentor tab and you could get going. And if you'd like, you could enter your name, location, and email address in the chat function, and we'll get that information to the proper chapter to have you get the opportunity to start receiving the advice of a SCORE mentor. Again, that's completely free, absolutely confidential, very informal, and we have found it to be a significant assistance to people who are trying to get some help with their business activities. Just a couple of rules for today. We'd ask that you use the Q&A feature to ask any questions that you have. The reason for that, we'll be keeping track of questions as they come in during the course of our discussion. And it's simply easier for us to do that if we have to look only at one feature. So please use the Q&A and not the chat. This webinar, as you know, is being recorded. We'll send a link to the recording to you in an email in the next day or two, so that you can have access to the recording on a going forward basis. And with that, I will turn things over to my friend and colleague, Gloria Spence from the Boston chapter. Gloria, take it away.
Hello, everybody. Again, my name is Gloria Spence, and I was a SCORE counselor for about 5 years, and I do present right now just workshops. This is the cash flow report is a favorite of a lot of the SCORE counselors because it's really the basis for the fundamental financials of your business. So what we're going to cover today is a brief overview of the basic financial statements, just briefly talk about the startup costs and budgeting in case you are in that phase of your business. We're going to get into some details about the cash flow statement, how to prepare it, how to analyze it, how to use it effectively. And then we're going to follow up some other ways how to manage it and forecast it, and some tricks and tips to keep it going. What did I do wrong, huh?
I just moved the slide for you.
Oh, you did? I'm sorry. So then I don't want to do that. I didn't know you were going to move
I'll have to bring it back up again.
Please, sorry about that.
That's okay.
All right. So the objective of financial reporting system is to gather accurate and complete information in a timely fashion. And you need this information so that you can make some and better educated decisions about your business. So the key to this is that the information needs to be accurate, needs to be complete, and it also needs to be timely too. The reports don't help you very much if you are playing catch up after 6 or 8 months. So you've lost some information at that point. Next, is that me?
You can advance or I will. I got it.
Whoops. So the 4 basic statements, 3 is a little bit of the budget is a questionable one because the budget and the cash flow statement can be the same. But the 4 basic statements are an income statement, which is also another name for a P&L or a profit and loss statement. And this report shows results of a business for a defined period of time. It is the gathering of information that is inputted into your accounting software system. And the same thing with the balance sheet. It is a snapshot of the financial position of a specific date, and it reflects what the business owns and what the business owes to other people. So those 2 statements are purely gathering of information of whatever it is that you are inputting into your system. The cash flow statement, on the other hand, it shows where the business cash has come from and where it has gone over a defined period of time. So the cash flow statement is a combination of actual information as each month goes by, and then the future is also a projection or a budget or a forecast. That's the hardest part about this cash flow statement, is because you've got to understand your business, where it's going, what's going to happen to it. You have to understand the market and all these other things to be able to accurately forecast your revenue, which is the hardest part. And then also from the ground up, forecast your expenses. Again, the budget reflects your forecasted performance over the next period of time. A budget should be prepared for every calendar fiscal year that you are in business. It should be done ahead of time, and it should be your guide as to how you are going to achieve your financial goals over the next year. So briefly, just for startups, if there is anybody here who is in the startup phase of their business, it's very, very important that you prepare a cash flow budget, and you want to show your costs of not only on an ongoing basis, but you want to show any of your costs that you will need to incur before you are up and running your business. There's also an initial period that you should have some cash available in case, most likely, you won't reach a break-even point in the beginning of your startup business. A lot of businesses don't make any money for the first 6 to 18 months, and you should have a contingency to cover those expenses to keep you going until you can make a profit. So this cash flow budget will help you through that process. And then there are other webinars specifically on startups that we have that will get into more detail about the differences between that and a regular ongoing cash flow budget. Okay, so what's a cash flow statement? It shows the movement of cash in and out of your business. You should develop an ongoing discipline at looking at this report at least monthly. And that's why it's important that you have accurate and timely information into your accounting software, so that come the first of the month, the 5th of the month, you can go back and look and see what your progress has been for the last month. Did you make money? Did you lose money? Did you grow? Did you lose track? These are important things to know so that you can see a trend and adjust to it. There's a couple reports on the website here that we've included that can help you with the cash flow report that you're welcome to take a look at. So what we're going to talk about, I'm going to pull up an Excel spreadsheet of an actual cash flow statement, and I'm going to show you some what if scenarios that you can play around with. So you want to prepare, when you go to prepare a cash flow statement, you want to ask yourself 3 questions. How much cash do I need? Which is, how much do I need to cover my expenses on an ongoing basis, on a monthly basis? And then you want to ask yourself, how much money do I want to make from this business? How much money do I need for my own personal standard of living? Is it $5,000 a month? Is it $60,000 a year? $100,000? You need to determine that. And then you have to come back and have a reality check and say, okay, can I generate this much revenue to cover both of those? Again, as I mentioned before, a lot of times businesses can't do that in the beginning. And this is what you need to know. You need to know, is that period going to last me 1 month, 2 months, 8 months, 10 months? Do I have personal cash to keep my own personal expenses alive and being paid or not? And it's also a tool to use to manage your business. Not only to watch for downtrends, but are you making more money than you thought you would? Is it time to expand? Do you need to add more employees? Do you need to open another location? Do you want to open up another location? These are all questions to ask yourself on how to manage your business, not just when you're looking for needed cash, but when you have too much cash. What a problem. Wouldn't you like to know if I have too much cash? Most people would. So here is a very oversimplified worksheet of what a cash flow report looks like. You can see we start out with the beginning balance. We add how much cash we've got in. We've deducted our outflows, and now we come down here and we show the ending cash balance. And you can see that the cash flow has changed, gone down or gone up in some cases. Okay, so now I'm going to attempt to bring up my report. Okay, so here is a very busy, and I've got a number of different tabs down here that I'll go through. But this first tab would be what I would call your original cash flow budget that you prepared back in 2022. Now, you start up here with a balance, how much you started out with, $51,000 in this case. And here's the line where you are going to predict your revenue. I'm going to predict that I'm going to make $275,000 in revenue this year. And here are a list of all of my expenses, which is going to be subtracted from that cash. And then this number here is going to tell me each month how much cash I have left over. Okay, so things are looking really good. If all these numbers come into play and they're all actual numbers, you're going to end up with $118,000 in cash, double what you had at the beginning of the year. Now, I'm going to ask you to ignore these 2 lines here because they are a little bit more advanced, but I wanted to include them in the worksheet in case anybody had these and could use them and made sure that they accounted for these things. But it's an advanced little part of a business, so we don't really need to get into it. But what is important down here is that if you are a certain type of entity, you will need to take a draw from your business, and you need to say what that number is down here. And for in this particular case, we said it's a $5,000 a month or $60,000, and this is before taxes. Okay, so this is a very broad summary. I'm going to show you a very detailed report, which I'm not going to use, but I did want you to see that there's a number of different expenses that you should address. We're going to work with totals on these reports so it doesn't get too cumbersome, but you do want to be able to detail your expenses, whether you're starting out or if you have some historical information. You want to have as much detail that will help you, but you got to be careful about too much detail. So let's move on to actuals. Okay, so here we are at the end of March. And these numbers here are now actual numbers. Anything in the gray shaded area, you will have come back and put these numbers into this sheet. So now at any given point in time, you will see what you've actually done and what you're going to do. Same thing down here with your expenses. And I'm going to jump to April because it's more condensed. So you can see here that my actual sales cash was $14,000, $18,500, $16,900. So if you were not to look at these numbers on a monthly basis, you might not notice that you're trending down in your revenue. So when you see this, you may want to come back and say, oh, I'm trending down. Granted, $1,000 may not be very much, but if, you know, you kind of have to find out why that is sooner than later. So, and then these blue numbers up here are what our forecast is. So if I think I'm trending down, I want to prepare for that. And then I can just go in there and change these numbers. But first I want to jump down here to the expenses, and I want you to see here what we've done. So this is our payroll line, and our payroll is 7,000, 8,000, 10,000. And so what my plan is telling me here that I made plans to increase my staff. Now, if I start to see that my revenue is going down, I need to adjust for that and not necessarily add the staff. And I can do that by knocking these numbers down for 1 month, for 6 months, for however many months I think is necessary. And that will all change these numbers down here. So, and up here, I put in here, this is something I added that's for comparison and analysis purposes. This is what my budget was. So now I am saying that I'm not going to make my budget. I'm going to be $60,000 under budget. What does that do to my number down here? Well, I was going to double my cash from 51,000 to 100. Now I only have 55. But I did get a salary. I did get $60,000 paid to me. I'm going to move on to May. So again, another scenario here. And again, you know, I put the money back in here. I did a scenario that says I'm going to keep my payroll numbers here, and look what happens to my number. I start to lose money here. And you'd like to know this sooner than later. So what are your choices here? How can you fix this? 3 things. And come up here and figure out what the heck is going on with your revenue. Why is it dropping? You can come in here and start to cut expenses. And you could not give yourself a salary. So those would be your 3 options. Am I missing an option, Jim?
No, you've got them. That's it.
Yeah, so those are the 3 things that you do. And of course, nobody wants to do this last one. But, you know, sometimes it's hard to figure out why your revenue is down. It may not be an easy answer. And then you want to come back in here and take a look at these numbers and see what you can cut out. Is it time to cut your payroll or not? Something that you'll have to take a look at. It may change your growth plans if you decide to not staff your business as much as you thought you did. I'm going to pause there for now. Are there any questions?
Yes, we got one question. Is the cash flow the same as a pro forma statement?
I don't think so. What? No. What is it? I don't know what you mean by pro forma.
I think, you know, they're thinking about a pro forma statement as a what if statement. Here's
Well,
what
this
it
is
would
a what
look like
if.
if.
I mean, you can do what ifs with this. I mean,
This is really a forecast, it's
Yeah.
your budget and you're bringing in the reality of the actual performance to see how it impacts what you've looked at for going forward.
yeah, I mean, you can do what ifs here. I mean, here's
Right.
insurance here for $4,100. Maybe I decide to spread that over 12 months, pay it in installment plans to kind of reduce that burden. If I did that, if I did this, change this number to $250, all of a sudden I make a profit. I mean, depending on the type of entity that you set up, this also could serve as your profit and loss statement as well. If you don't have anything fancy, these lines here could also be your profit and loss statement. Any other questions?
Would I
No.
want to do a side by side with what I projected versus the actuals within the same document?
I'm sorry, that was the question?
Yes.
Yeah, I mean, I kind of did that over here on this far right. I put what my budget was in total, so I could see where I'm off in total. To get a specific year-to-date analysis, you'd probably, I mean, if you're using QuickBooks does a cash flow report, but I think you'd still have to go in there and massage it to give you a year-to-date comparison. You could do it.
I also think it can get a little bit cumbersome to try to have actual month versus projected month, actual month versus, it gets to be a very long statement. In my experience, you're better off to actually print out and have your original budget and forecast for the year, and then compare to the actuals as the actuals take place.
Yeah, I think that's a good idea. And, it's easier to take a look at. And then what you can do is hone in on the big items. The big items, the things that catch your eyes as being something that is over or under will be a little bit more obvious to you. Yeah.
And then would I be using this day-to-day to know where I've increased or decreased?
I wouldn't use this on a day-to-day. That would be very, very cumbersome. I would say on a monthly basis. I mean, you could look at it. I mean, I don't know if I would recommend looking at it before.
Now, the only time I would think about doing it more frequently is if I started to have real concerns about what was going on with my business. And then I might break it down week to week.
And probably at that point, I would go into some type of a sales report that you have to see, to look at that sales report, to see what you have there, and then kind of compare that to what you need to have that month. I don't know that I would do that with this report. It'd be adding another guess to the already guess.
And the reason is that it's actually set up month to month, and so it isn't really day to day. It doesn't give you the day-to-day information. You would probably know it. For example, if you said you were going to have $50,000 of revenue in a given month, you will know what your weekly revenue should be in order to be able to hit that target. So, as an active manager of your business, that's the kind of thing you would be doing. How do amortized expenses affect this?
That's what those bottom lines are down the bottom. The amortization is down the bottom after the total expenses, because this report, cash flow, is really capturing the transactions that go through your bank, your checking account. So if you are amortizing, depreciating, or any of those, you would see a lump sum coming out of your checking account for the $4,100 that I showed you before was the business insurance. That would come out, but it would not be a reflection of your profit. It would just be a reflection of your cash going in and out.
Right, and that's the important distinction. So you're trying to hear and take care of your cash flow, right? So if you pay that $4,100 in a given month, it's not necessarily an expense in that month for a profit and loss income statement perspective, but it did go out the door from a cash point of view, and that's what this statement is trying to capture.
Exactly. Yep. Good questions.
There's another one in the chat. What entities are required to have do an owner draw? And are there rules for the minimum and maximum value of the draw?
A sole proprietor takes a draw, and some LLCs take a draw, and everything else, I believe, is all salary based.
Yeah, there's no entities in which you're required to take a draw, but if you take cash out, then it is a draw. I hope that answers your question. So if you have a sole proprietorship, there's no difference. The business is you. If you form an LLC or a corporation, then the business is that entity. And if you take money out, then it is considered to be either a draw in the case of an LLC or a salary in the case of a corporation. There's no min-max values of the draw either.
Correct. You could keep that money in the business forever until you are able to, maybe you're saving up to expand. So you could certainly do that. The other thing too is to be aware of is that when you are a sole proprietor, you are not taxed on the money that you withdraw from the business. You are taxed on a profit basis. If you make a profit, then that's what you're paying taxes on. If you have a loss, then you have a loss. With a corporation or an S corp, it's not that way. It's not based on your profits. It's based on what you're getting paid.
In an LLC, it's taxed like a partnership. So all of the income and loss of the LLC flows through to the members of that LLC. And then the question was, why are the loan payments broken out separately? Go ahead, Gloria.
Well, because it's an accounting thing. The loan you're getting your expense on your loan is your interest, not your payment. So that's the difference there. You're paying this loan off, and the expense is interest, not the amount of the payment. It's an accounting thing. So
yeah, it really started because the cash flow statement comes from the income statement. And then you make various adjustments to it. That's the technical way that the accountants would prepare a cash flow statement. And so amortization, payment of principal, is not an expense. It's a use of cash that comes in, quote unquote, below the line. That's why that is treated that way.
And we mentioned one of the reports earlier, the balance sheet. The loan would show up on your balance sheet because it is a debt. So the principal of that loan would show up on your balance sheet.
And in the income statement, you would reflect both the payment of interest and any payment. That's the only expense that you would have, is the payment of interest. The next question is, can you discuss the benefits of having the LLC related to cash flow and taxes? Well, the first benefit of an LLC is actually to shield you from personal liability for the operations of the business. So that if you have a sole proprietorship, there's no separation. So everything the business does is you. If there's any liability generated by the business, you're personally responsible for it. So the reason that one would form an LLC, among others, but a primary reason, is that you create that entity, and the entity has the liabilities for anything that happens in the business, not you personally. So that's the primary benefit of creating a limited liability company. In terms of cash flow, there really is no difference between an LLC and a sole proprietorship, except that if you take money out in the sole proprietorship, It's just your money, and you're taxed on the results of business without regard to any intervening entity. If you take cash out of an LLC, it is typically considered to be a draw, and you may end up, and that's a little bit beyond the scope of this conversation today because it gets technically complicated for tax purposes, but you will have self-employment income tax for the amounts that you take out of an LLC. So forming an LLC gives you liability protection. It can actually also increase your income tax responsibilities because of the
I always-
self-employment tax.
I'd like to suggest to business owners, when they decide on their legal entity, to not only speak with an attorney about it, but also to speak with the CPA about it too. Because
Correct.
there are definitely implications to both the protection that Jim was talking about, the legal part of it all, but also from the tax standpoint too. You may find, I mean, I know clients who can't manage the draws. You know, they need to have, you know, X amount of dollars coming every month, and you know they have a hard time adjusting to that. If that's the case, then you need to look at something besides a sole proprietor and get yourself on the payroll. It's hard to run a business and also your personal finances at the same time. It's a challenge.
But Gloria's exactly right. When you start forming entities, you need to be very careful about the tax implication of those entities, and you should absolutely talk to an accountant about that. It's a little bit beyond the scope of what we're trying to cover today. Okay, Gloria, that's the questions that we had on that. So if you want to stop sharing. And I will bring back up. Okay, to talk a little bit about cash flow from the perspective of the operations of your business. You've all heard a gajillion times that cash is king. And there's a reason that people say that all the time. It's because it's true. In fact, if you look, most failures of small businesses arise as a result of cash flow problems. Running out of cash is a death knell for a small business in particular, because your options are so much fewer than in a larger entity. I used to tell people that worked for me that we could survive anything and plan for another day, so long as we didn't run out of cash. So it's imperative that you stay on top of your cash resources and your current and future cash needs in order to avoid a liquidity crunch. I'm going to talk some about some simple things that you can do that we think will really help you to make sure that you keep control of your cash. First, it's absolutely important that you keep a separate bank account for your business. Run all of your receipts and expenses of the business through that account and none of your personal expenses. I've had clients in my mentoring experience that did not do this, and they had a very hard time figuring out what the actual results of the business were when they sat down to try to figure out how they were doing. It's also an easy way to monitor your cash, and it makes your eventual tax return preparation a lot easier. I'd also recommend, if possible, that you have a separate credit card for your business. Why? Well, again, it keeps everything separate between your personal life and your business life, which is very important. People say, well, I have a debit card for my business. Isn't that enough? And that's good. But a debit card is only going to get you the ability to spend money that you actually have in the bank account. Having a credit card gives you the ability to start creating a credit rating for your business. And it also, in certain circumstances, may be something that you can use to cover costs that you don't have cash for or other financing for. Not advocating you do that a lot, because if you don't pay that bill on a monthly basis, it can be a very expensive way to borrow money, but it is something that would be available to you if, for example, you needed to buy significant inventory very quickly. So having a separate bank account, a separate credit card for your business will significantly help you to manage your affairs. As Gloria said, you should also look at your cash flow statement on a regular basis, at least monthly. Keep that cash flow forecast for the next 12 months and keep it updated because things change. Your revenue may not be what you thought it was going to be. You may have had higher expenses than you anticipated. And you need to stay on top of those to be sure that you are aware of your liquidity needs. Why? Well, because you be making decisions about your business constantly. And if you do that without taking into account the impact it could have on your liquidity, you may be making a mistake that gets you into trouble. You should maintain good accounts receivable collection practices if you're in a business that generates accounts receivable. And I'll talk some about what those are. And you should avoid overdoing it on supplies, inventories, equipment. I know everybody wants to have everything they need, but recognize that those expenses eat up cash. And so you should only be buying what you really need, not what you would love to have. You should prepare that cash flow forecast each year as part of your annual budgeting process and update it every month, or more frequently if you have to, if things get more difficult. And if you start to see that you're having immediate liquidity needs, then you need to look carefully at the next week and the next month to see if there are immediate issues that you need to attend to, because things change and you're going to be making decisions. Should I hire people? Should I buy equipment? Should I buy inventory? Should I take on work? Do I have to reduce expenses? Unless you can see what your cash situation is going to be over the next 12 months, you're not making those decisions with the full benefit of the understanding their impact upon your liquidity. And this is something that's very important, particularly down here on the Cape where I am. You have to bear the seasonality of businesses in mind. I've seen people that I've worked with down here. They're feeling great in June, July, and August. But in my humble experience, every year still has a January, February, and March, and things will be much slower then. And so you need to take that into account when you're putting together your cash flow forecast. If you see a cash shortfall coming, take steps to deal with it as soon as you can. Seek working capital or other loans, reduce unnecessary expenses. You could delay purchase decisions. You might delay paying bills. You could accelerate collections. And if you have real big problems, you may need to sit with people that supply you and explain what the situation is and when payment will be made. Be careful in doing this because you don't want to create a great deal of fear about your financial circumstances, but people do appreciate it if you have a temporary problem that you want to try to address yourself to and be honest with them about what's going on. And if possible, you should try to keep cash reserves and or establish a working capital line of credit, which I'll talk about some, to help you deal with shortfalls. Now, I want to go back just for a minute to that very simple cash flow forecast that had been put together, just to talk about what this means and what decisions were made. Again, it's very simplistic. It's 6 months, not 12. Don't yell at me. I know I said 12. But it's 6 months because if it gets to be 12 months, the numbers are a lot smaller. This is just easier to see. Small business starts out the year with $20,000, ends up June, if you look at the bottom right, $6,000. So that's pretty good. Brought in $335,000 of cash, outflows of $349,000. So I had a negative flow of cash in the first 6 months of the year of $14,000, but it started out with $20,000. So, you know, it's tight, but it's okay. Well, not exactly, because if you look at the middle of the year, at the middle of the 6 month period, notice at the end of March, this business is now negative cash. It's negative $3,000. Well, had you been running that business and you realized that that was going to be the case, you might not have bought as much of this inventory in the first 2 months of the year as this business acquired. So it spent $30,000 for inventory in 2 months. And I know they will probably say they were gearing up for the season, but that was cash out the door. They could have maybe, if they anticipated where they were going to be, they could have bought that on credit. They could have slowed the inventory purchase down or taken other steps to be sure that they were not going to get into a negative cash position. They also had an equipment purchase of $12,000 in March. Now, small numbers, but that put them in the negative. Now, they would not necessarily have bought that piece of equipment had they been aware that that would put them in that negative posture, or they might have sought to buy that equipment on credit, because in fact, for small businesses, one of the most ready forms of credit availability is from equipment vendors. They may be prepared to lease the equipment to you. They may be prepared to loan you the money to buy it, effectively taking back a lien on it. And that helps to create the opportunity to avoid that negative cash position that the business ended up in. So again, this is not huge numbers, but if you start seeing negative cash balances, then you're going to have a problem you have to deal with. And the sooner you understand what's coming, the better you'll be able to make smart decisions that will avoid that circumstance. Now, I wanted to talk some about accounts receivable. It is, in my experience in working with small businesses over the last 10 years, accounts receivable is one of the biggest problems that people in business have. Now, if you're in a retail business, you won't have that. But if you're in a service business, you definitely do. And this causes as many liquidity problems as almost anything else. So it's important that you develop and maintain good practices. What do those include? You see them listed here. Timely billing. I had a client once who just didn't like doing the bills. Well, you ought to get the bills out as soon as the work is done. Clearly state what's been done, what's owed, and when payment is due. Most accounting systems have an invoicing tool, which makes this a very easy automatic process and then allows you to track payments efficiently and integrate the payments with your accounting system. I'd encourage you strongly to do that. Some of those accounting systems cost money. There are many that are free. We don't advocate any one in particular. QuickBooks is probably the most commonly used, but develop a system for making sure that you get the bills out on time, whether you use an accounting invoicing system or you just do it the old-fashioned way. But don't delay. You ought to send those bills out both by regular mail and by email. Make it clear how checks should be sent and where they should be, how they should be made out. You want to add instructions for online payment or debit or credit card if you're going to accept that, and get to know who's actually making payments if you're dealing with businesses, and communicate with them regularly, because I used to always tell my colleagues that one of the most important people to get to know is the assistant to whoever's doing the business, because if you get to know them, you'll be able to get yourself to the top of the pile. I'd also encourage you, if you're in a service business, to consider starting to take payment by remote means. People use Stripe or any other form of mode. You can accept credit card payment right away, and therefore you get out of the entire billing and accounts receivable issue. You or somebody in your organization needs to monitor the collection process. Make sure you get notice out when payments are late, and reach out to customers when amounts have not been paid when due. You can send a formal letter, but this starts to get complicated. If it's a serious delinquency, one thing you should do is not continue to provide services or goods to somebody who isn't paying you. You can send a formal letter. Don't threaten, because that can get you into legal problems, but add language saying it's an attempt to collect the debt. I have one client who absolutely insists anytime they're not paid, they take people to court, including small claims court. Well, you can consider doing the same thing, but recognize that there is an expense involved. And also, you should check the ability of the debtor to pay before you do that, because many times people aren't paying you not because they don't want to, it's because they can't. So be prepared. In my view, you should be prepared to cut price and collect what you can before proceeding. I'd also suggest that you consider early payment and prepayment discounts for customers. So I have somebody who works on my sprinkler system, and they give me the opportunity to pay the full year's basic fee in advance in March at a 7.5% discount. Sorry. Why did they do that? Well, it gets them out of the whole collection problem gets them some cash in some of their slower periods. And I do it because I'm happy to get it. Now, I think you have to be careful about the level of the discount and don't provide it to people who aren't going to pay you. But a 5%, 7.5% discount can really get you much quicker payments and get you out of the whole accounts receivable issue. You might get credit card authorization, and you consider using mobile payment and credit card charging apps. If you're in a construction business, bigger projects, you should make sure you get a payment schedule up front that works for you. You should make sure that you get paid for your supplies when you buy them or in advance, depending upon how large it is. And make sure you've worked that out with your customer so that you're not laying out cash and then hoping to get it back from them. Other working capital tips. Well, what is working capital? It's a fancy accounting term for the cash, accounts receivable, and inventory, your current assets, minus your current liabilities, what you're going to have to pay in a short period of time. So you want to make sure that you keep a reasonable level of positive working capital in your business. Again, avoid overbuying supplies, equipment, etc. Make all of your purchasing decisions with the impact on cash flow in mind. You should pay your accounts payable on time, but don't pay them early. If somebody gives you 60 days to pay it on the 58th day. You want to be a good customer, but it's your money. You should not pay it 2 days after you get the bill just because you don't want to have to worry about forgetting to pay it. Create a system that will give you reminders of when to pay. And if you don't want to do that yourself, use a bookkeeper or somebody else in your organization to make sure it gets done on time, but not early. I've seen people do this, and it's a very bad practice. If you have employee tax withholdings or sales or meals tax receipts, that is not your cash. I've seen people say, well, I'm a little bit short right now. I know I'm going to be able to make it up, so I'm going to use that money to pay a certain bill, and then I'll make it up when in the next month. Well, somehow that month didn't come and they didn't do it, and that's a real problem because you're going to be exposed to significant penalties for doing this. So if you have employee tax withholdings, sales or meals taxes, that's not your cash. Pay it over to the authorities at the appropriate amount of time. All right, so we've talked some about financing, whether it's a working capital line of credit. You're a small business, where do I go to get money? Well, the typical ones when you're starting a business will be what we call family and friends, which is not just immediate family members, but people that you know, that you may talk about your business idea about and get some advance money from. You may have personal savings or assets that you're going to use in the business. What level? I get asked this all the time. Should I be prepared to use? That's an absolutely personal decision about how much risk you are prepared to take. But you should make sure that if you have put together a retirement nest egg, if you start to use that in the business, it's at risk. So you should make sure that you're comfortable doing that. And you should talk about that, not just to yourself in the mirror, but with your family. I mentioned how credit cards can be a source of financing to you, but recognize they have high costs. So what else do you do? Well, you have bank loans. For small businesses, money center bank loans are very difficult to obtain, but they're possible. What will a bank look at? Well, I'll talk about that in a minute, but recognize that you talk about bank financing or SBA financing, most often you are going to be required to provide a personal guarantee of the amount that you borrow. And that's something that you need to step back and realize is a matter of your personal risk in running your business. It's not that banks want necessarily to be suing you to get paid back, but they want to understand that you have enough confidence in your ability to be successful that you're prepared to pay. I would also tell you that you're likely to have more success dealing with smaller banks, credit unions, community banks, those kinds of facilities where you will have people who are more accustomed to dealing with small businesses. The SBA is a very good source of financing, and you can go on the SBA website and look at their lender match to see what kind of financing might be available to you. Some of that is direct from the SBA. Others is by loan lenders who are being supported by an SBA guarantee. You'll hear a lot of talk about online lenders, and there are a lot of them. They may make borrowing easier. They will still look at your personal credit rating, and they can be expensive. So you should be careful in dealing with them. But there are places like the Lending Club, Cabbage, On Deck, etc. There's many of them, but they will charge fees and interest, and you should be sure to understand the full expense that is entailed in borrowing on that source. Crowdfunding is very difficult. It is really a very specialized kind of funding that requires a lot of work on your part with videos and conversations and communication. So it's only really going to be for very special and unique circumstances that crowdfunding would be available to you.
Jim, can I add, somebody asked the question, and I'm going to elaborate a little bit.
Sure.
The question is there a less risky way to borrow money for your business than a credit card? And I think Jim went through a number of those. The other one that I would want to mention is a line of credit, if you can get that when things are good. And then again, you don't have to use it when you need it or when you probably wouldn't get it. So, you know, a line of credit would be another option to have there.
Yeah, to explain what a line of credit is, what you do is you go to a lending institution and they agree to lend you up to a certain amount of money. So let's say you felt you wanted to get a line of credit for $25,000. Well, the bank would agree that they would loan to you at your request up to $25,000 as needed for your business. You would pay for that. You pay a commitment fee, plus you pay an interest cost whenever your loan money is outstanding. And it's a revolver so that you can borrow and pay back and borrow and pay back. Typically, you will be required to pay it back in full at least once a year and allow it to remain at zero for 30 days. But if you can achieve getting a working capital line of credit, then you've put yourself in a position where you have a safety valve. So that if you have cash needs, whether that's because of the seasonality of your business, unexpected expenses, you can get to a place where you have the availability of funding for you. I saw somebody also ask what's a good rule of thumb for keeping cash in terms of an amount on hand. Well, you know, you could talk to 15 finance professionals, you'd probably get 21 answers. I would think a rule of thumb, if you had 6 months of expenses covered, then you should be in pretty good shape. I don't know, Gloria, if you feel differently.
Yeah, 6 would be the minimum, the ideal. That's not to say businesses all have that, but
right.
I would feel comfortable with the minimum of 6.
Yeah. Are interest rates high for line of credit? Well, they're not any higher than they are for regular loans. The difference is that you will pay a commitment fee for the unused borrowings, so that in addition to the interest on what you've actually borrowed, you will pay the bank a fee which can vary in amount so there's that $25,000 example, you may pay a commitment fee of 1% a year for the entire time that is outstanding and not borrowed. So that should be added to your expected total costs. For very small businesses, lines of credit are very difficult to achieve, but they are absolutely things that you should try to put in place as soon as you can. So you go to a bank, what is the bank going to look at to try to decide whether they should loan you money? Well, they're going to look at collateral. What assets can they look to for repayment? Does your business have a building? Do you have a home that has equity value over the mortgage amount? They're going to look at a personal guarantee. They're going to look at your character, and they call these the 5 C's. You know, what is your experience? Why should they be confident that you're going to be successful in your business? Now, what's your relevant education level and experience to know that that's the case? They'll look at your personal credit to be sure. And credit ratings will be very important. They'll look at the business conditions that you're facing. What are the external threats to your business? What new developments are taking place? They'll look at the ability of the business to repay, and they will look at the equity in the business. A couple of things that we would recommend strongly that you do. You should establish a banking relationship right out of the blocks, even if you're not looking to get a loan. Why? It's much easier to ask for a loan after you've established a relationship with the bank, as opposed to going in and asking them right away on a cold call basis, can you make me a loan? So you're going to have that bank account that we talked about earlier for your business, and you're going to want to meet with the bank officers about that account and explain to them what your business and what you're doing and what you hope to do, and meet with them periodically just to keep touch with them, and so they can understand how your business is going. Because having that banking relationship will help you a great deal if you get to a place where you actually find yourself needing money. You
Jim,
should make sure.
There's one
Go
more
ahead.
question here. It says here, are grants easier to get with a small startup rather than traditional bank financing?
Are grants easier to get?
Yes.
Well, that all depends, obviously. Grants, getting a grant is a great thing. Typically that is going to be for a nonprofit. But there are grants available for nonprofits and for profit-making entities. Grants can come from governmental and quasi-governmental entities. They can come from foundations and others. But those are more situational. You've got to find who's making a grant for the area that you care about. And then you have to submit an application. But certainly it is worth the effort. If you think that your business qualifies for a grant, it is certainly worth pursuing that. But I don't view those as alternatives. I think you should be pursuing a line of credit or other credit support from a financial institution, as well as grants, because if you're eligible, because grants are a one-time thing. And you may not get them in the right amount. It is subject to the whims of whatever grant committee might be interested in doing at a particular point in time. So they don't really replace traditional commercial financing. I don't know if you have a different perspective on that or not.
No, not at all. They're not easy to find. And again, like Jim said, they are oftentimes industry specific. So, I wouldn't rely on that as a first option.
And also, it's always a function of your time as well. Grant applications take time. Seeking outside financing takes time. You've got to establish the priorities that you're going to follow for yourself in pursuing your business activities. Because in addition to all of that, you still have to run the business. And so make sure that you don't get so caught up in pursuing all these other things that you lose touch with the business itself on a going forward basis. My view is that as a business owner, you have several major responsibilities, but if I boil them down to two, it's to keep track of your cash and pursue revenues. There's lots more than that, but those are two things that you can't outsource to other people without real risk. So do we have any other questions at this point?
I don't see any.
You'll see here, the merchant credit for supplies. Just as with banks, it's very useful to make sure that you have good relationships with your suppliers. I mentioned before that equipment sellers can be a ready source of credit for small businesses. So too can other merchants be. So you should not hesitate to talk to your suppliers about having merchant credit available to you. You don't want to scare people about your needing credit, But, if you have regular suppliers, if they would supply you and give you 60 days to pay, that's always helpful. And make sure that you work on establishing a good track record for your future needs. Nothing will scare a potential lender away more than you're not having good, comprehensive business records in place. So if you go to a meeting with a bank and you can't deliver to them a cash flow statement and a budget and explain what is in them, then you're doing yourself a disservice. So make sure that you have good business records in place and that you establish as good a track record as you can for your management capacity related to your business. We have any other questions?
I don't see any.
Okay. Well, thank you, everybody, for attending. Both Gloria and I would be available to anybody who has any questions. You can reach me at jim.danhauser@scorevolunteer.org. I'll make sure that gets included in the email that gets sent out to you with the link to the recording.
Thank you all for attending.
Thanks, everybody.